today's part with the following interruption for a public service announcement.
Welcome to the Investing in Intelligence show, where we talk about artificial intelligence companies, stocks, and trading using the most advanced artificial intelligence models in the world. Remember that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. The rules of economics are like poorly understood laws of physics. They're there and they matter, we just don't fully understand how they work. For example, we know that the economy adding less than 125,000 jobs per month is a warning for recession, and less than 100,000 is even scarier. So the current 3-month average, less than 40,000, is a bit terrifying. But there's more. We can't forget that 2024 had 3 months of jobs added less than 80,000, and 2 of those months were actually less than 60,000. And by the way, there has never been an official NBER recession without a significant rise in the unemployment rate. While there are less jobs being added now, there's also less people looking for jobs due to decreased immigration. When both workers seeking jobs and workers finding jobs go down, the unemployment rate doesn't go up. And by the way, what determines whether Americans find new jobs or keep the job they currently have is ultimately the health of corporate profits. With a few exceptions like UPS and the increasingly dreaded ASML, most corporate earnings and guidance have been great. And even though large cap tech stocks are all that the fin media seems to care about these days, in the overall market, we've seen 82% of companies beat earnings estimates, the highest since 2021. Remember that Mag 7 makes 60% of revenues outside the US, so a weaker dollar leads to better revenues and is helping these companies a lot. That being said, you can expect overall index upside to be limited for a month until we get the next labor report at the start of July. Even if Trump tries to cook the books on official labor data, we still have ADP and other data we can look at. It's hard to hide a recession, since in the end, a recession is visible in the reports of US companies. At Investing in Intelligence, we've had some big winners this year, like the stocks we recommended in our last episode, Seagate and Western Digital, both of which are up 70% over the last 3 months. Of course, our biggest winners have been the IPOs we bought, and there might be another one of those coming later this year. Indeed, the next big AI IPO to watch out for is Databricks. It's expected they'll IPO in the next 4 months, and this is one we'll be buying hand over fist. Databricks is a cloud-based platform that helps companies store and analyze data for, of course, AI. And they've been growing at 60% year over year with gross margins above 80%. In other words, Databricks has much better numbers than other AI IPO successes like CoreWeave and Circle, and they just have a better business model. Unfortunately, Databricks might be the last great AI IPO of 2025, but if economic data starts to fall out, we might not even get Databricks until 2026. Economic data meaning not just jobs numbers, but also the unemployment rate and the key ISM services number coming on Tuesday. The US is a service economy, and only 9% of all US GDP is subject to tariffs on goods. If the ISM services number on Tuesday is drastically lower than expected, expect a drastic sell-off in stocks. That seems a bit unlikely though, as corporate earnings have been good, GDP has been good, the last ADP employment report was good, and weekly jobless claims numbers haven't been too bad. Just that monthly labor report. So it doesn't seem like it's time to run and hide yet, but tariffs will be a huge threat to the economy into 2026. We're currently passing the initial test for tariff impact, but it will take about another 5 months for inventories to be drawn down due to the massive pre-ordering. So experts at Bloomberg believe it won't be until late 2026 that we know the full effect of tariffs. Remember, businesses want to be the last to increase prices so that they don't lose market share. So a lot of businesses haven't increased prices yet, meaning more significant inflation may be coming later in the year and next year. All of this is reason to be extremely cautious with holding healthcare stocks, staples, transports, etc. None of this is reason to stop holding AI stocks. As we muddle along with a weakening economy, AI is stronger than ever. So where is AI headed? We know last year was a year of reasoning models, and this year, 2025, is the year of AI video. Next year will be the year of agentic AI, and 2027 will be the year of ambient AI. Ambient AI refers to an operating system that ties together all your devices and apps into a single AI interface you can talk to or type to. Spoiler alert, ambient AI is probably the device that Johnny Ives and OpenAI are building together, as some kind of hardware will be necessary to make ambient AI work. All those things are made to assist humans in the digital world, but a new technology is poised to also take the place of humans in the physical world. That's right, 2028 will likely see the proliferation of humanoid AI robots. It is extremely difficult to make a humanoid robot walk, and as of today, Chinese robot manufacturer Unitree has a 4-foot-tall robot that walks and even runs flawlessly for $20,000. Think of the humanoid robot as a complement for the self-driving car. So in the past, people would buy cars as a tool, well, in the present too, to help them get around or even as a way to make money by driving others or delivering things. As AI and autonomous vehicles start to replace those functions, people will start to ask humanoid robots to do things they would normally do themselves, like go to the store for them in an autonomous vehicle or cook them dinner or mow the lawn. The humanoid robot will take the place of all human redundant physical actions, making humans more efficient and at times replacing humans, especially human laborers, entirely. But not before self-driving cars are widespread. I think that will come first. 8 million people drive for a living in this country, and most will lose their jobs. Uber realizes this and is trying to partner with Lucid to make their own autonomous vehicle push. But they're far behind Waymo, Tesla, and even Amazon on self-driving cars, even if they're far ahead on the software side of ride-hailing and delivery. Uber may be a short-term buy, but their long-term business is still very much threatened. So Uber is threatened by Google, which owns Waymo. Netflix is threatened by Google, which owns YouTube. And Google is threatened by all AI, since search is most of its revenue. It's a confusing web of threats, but we just don't own any of those three companies to sleep better at night. Speaking of autonomous vehicles, most autonomous vehicles will ultimately be electric vehicles. And one thing you're not expecting is that EVs may make a resurgence and begin to largely replace gas vehicles starting in 2027 and 2028. That's because a new battery technology called solid state is almost ready, and all EV makers plan to bring these batteries to their cars starting in 2027, 2028. And it may actually extend EV ranges up to 900 miles, according to Electric. My EV gets about 180 miles. For context, Toyota and Samsung are the top Asian companies pioneering the technology, but there's also an American company called QuantumScape that has made huge strides and is partnering with Volkswagen. Ticker QS is up 66% over the last 6 months, and we're about to take a small stake as a high-risk play on this segment. This is definitely a longer-term hold, multi-year hold, just like Rivian or Tesla would be. Speaking of Tesla, their recent conversations with suppliers indicate that they intend to manufacture many millions of Optimus robots over the next 10 years. Indeed, we're on the verge of an AI and robotics revolution, and owning UPS and Starbucks won't buy you a stake in that revolution. The average profit margin of the S&P 493, that's the S&P excluding the big tech Magnificent 7, is a sad 12%. The average revenue growth of the S&P 493 is even less, 10%. The Mag 7 have margins and revenue growth 2 to 3 times those numbers, and ultimately, stock returns are a reflection of growth and margins. Until next time, we'll be on the lookout for a Databricks IPO, we'll be gambling a bit on QuantumScape, and we'll keep our eyes focused, most importantly, on the unemployment rate and ISM services. Thanks for tuning into our show. Please give us a rating or review, or on YouTube, a like or comment, and we'll be back in the next episode to cover more AI stocks. You can find all our holdings and trades at investingintel.ai.
biggest revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. The revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.